Hello and welcome to this video on introduction and historical background of Forex. Forex trading began toward the end of the Second World War when member nations met at a place called Bretton Woods in Northern Hampshire, United States of America at the popular Bretton Woods Conference. It was in 1944 when the thoughts of what would happen in the post-World War era. So that prompted member nations to gather to plan out strategies to combat the ills that may begin to take place after the World War, particularly as regards international trade among member nations. So at the Bretton Woods Conference, member nations agreed around July of that same year. It was also in during this year in 1944 March that the IMF was set up, and it was set up to really help member nations. And at the convention, it was agreed that fixed rates of exchange be established, and gold was to be used as a benchmark for determining currency value. So gold was pegged against the US dollar. 1 ounce of gold at this time was going for around 35 US dollars, while the dollar was to trade against other currencies. Other currencies could exchange the dollar, but using gold to measure the value of the dollar. Now, the fixed rates of exchange served the world and the members of the United Nations very well for about 27 years until towards the late 1960s, when the US economy began to ail, and statistical financial reports coming out from the US, they were not encouraging at all. They were all pointing toward a declining US economy and weakening US dollar. Therefore, the United States government began to plan on ways to stop the backing of the US dollar with gold. And so by 1971, between 1971 and 1973, there was the introduction of floating rates of exchange, which was to mark the beginning of the end of the fixed rates of exchange that was introduced in 1944 at the Bretton Woods Conference. So it's all continued until 1976, precisely January 1976, when the floating rates of exchange was formalized by the International Monetary Fund, IMF. And so they set out the rules that were to govern the operations of the floating rates of exchange, that's the forex market. By the 1980s, since forex trading was only left in the hands of high net worth individuals and organizations, about $70 billion was said to be the daily turnover. However, around the 1990s, with the advent of the internet and the subsequent introduction of online trading, the daily turnover jumped up to over 1 trillion US dollars. And today, we are looking at something over $3.6 trillion to $4 trillion daily turnover. So the market is one with so large liquidity. It's a market with abundance. It's a market where if you must get your share, you must have a plan, you must have a strategy, and you must come prepared and disciplined. This is not a market for just anybody. It's a market for those who are ready to learn, for those who are ready to do things right, for those who are ready to be disciplined. So if you are ready, please go on and watch the other videos and pick on the lessons that you can. Try and make notes. When we get to the practice section, I'll guide you into putting into practice the things we'll be learning in this course. Thank you very much, and take time to watch the other videos.